Hey everyone, welcome back to Corporate Decoder. SCNX just filed an 8K about a material definitive agreement, and I'm seeing a significant shift in their funding strategy. Quick note, this is not financial advice, just my take on public filings for educational purposes. Scienture Holdings is taking on new debt that comes with some interesting strings attached, and we need to understand what this means. So what is happening here is that Scienture Holdings Incorporated, or SCNX as you might know it, has entered into a note purchase agreement. Think of it like the company borrowing money, but with some specific terms and conditions that are pretty important to unpack. On the 27th of April of 2026, the company signed a deal with Streeterville Capital, LLC. This deal involves two main promissory notes, which are basically fancy IOU slips. One is called Secured Promissory Note, a negative one, and it's for a hefty $8.42 million. The other is Secured Promissory Note B for $3 million. Now, Note a negative one has what's called an original issue discount of $400,000. This means the company effectively received $400,000 less than the face value of the note upfront. They also paid the lender $20,000 for transaction costs. Note B doesn't have this discount, which is a small difference but worth noting. At the time of this deal, the lender, Streeterville Capital, paid $8 million directly to the company, but here is where it gets a bit more complex. An additional $3 million was put into an account at Lakeside Bank. This account belongs to a new, totally owned subsidiary of Scienture called SCNX Holdings, LLC. This money is held under a special agreement, a deposit account control agreement, which involves SCNX, the lender, and the bank. The company says they plan to use this money for general corporate purposes, like working capital, developing their products, and other business needs. A group called Maxim Group LLC helped arrange this deal. Here is a really interesting part of the deal. For every $1 million that the company pays back on note, a negative one. They have the option to swap $1 million of note B for a new note that's similar to note a negative one. These new notes will have the same interest rates, discount terms, and other financial conditions as note a negative one. The maturity date for these new notes will be either 12 months from when they are issued or the remaining time left on Note B, whichever is longer. This basically gives the company some flexibility to manage its debt, potentially changing the structure of some of its obligations over time. Let's talk about the repayment terms for Note a negative one. The main amount of this note is due in 18 months from when it was issued. The interest rate on this note is 9% per year. The company can pay back this note early either all at once or in parts, but if they do an early payoff, especially if it is because they are refinancing with another lender, they have to pay a prepayment penalty. This penalty is 1/15% of the amount being paid back early. So it's quite expensive to pay off early in such situations. Starting 8 months after the deal closes, the lender has the right to ask for payments back in a couple of ways. They can request up to $175,000 per month, which they call a monthly redemption. They can also redeem up to 10% of the daily trading volume of the company's stock. If the stock price goes up by more than 20% compared to a specific price called the minimum price under NASDAQ rules, this is called a limited redemption. The lender can do this limited redemption within 5 trading days after the stock price hits that threshold. The money for these redemptions is usually due within 4 business days after the company gets the notice. Now, for Note B, the principal amount is also due 18 months after it's issued. The interest rate on Note B is lower at 5% per year. Similar to Note a negative one, the company can prepay Note B early, but again, they face a 1/15% prepayment premium if it's tied to third-party refinancing. This is where things can get serious. Both these notes have what are called major trigger events and minor trigger events. These are basically conditions that, if they happen, give the lender more power or can lead to the loan being called in. A major trigger event includes things like not paying any amounts due on the loan, if a receiver is appointed for the company's assets, if the company becomes insolvent or cannot pay its debts, or if the company files for bankruptcy. It also includes failing to follow certain rules in the purchase agreement or making a major change to the business, like a merger, without the lender's permission. A minor trigger event is a bit less severe but still important. This can include failing to fix a problem within 15 days after being notified by the lender, if any information the company provided turns out to be false or misleading, if the company does a stock reverse split without informing the lender at least 20 days in advance, or if there is a significant legal judgment against the company that isn't dealt with. It also covers scenarios where the company fails to maintain its listing on a stock exchange or breaches other important agreements. Now, here is the critical consequence of these trigger events. If a major trigger event happens, the lender can increase the outstanding loan amount for Note a negative one or Note B by 15%. If a minor trigger event occurs, they can increase it by 5%. This is called the trigger effect. However, The total increase from these trigger effects cannot go above 25% of the original loan amount. If the company fails to fix a trigger event within 5 trading days after the lender sends a notice demanding a fix, it automatically becomes an event of default. Once an event of default happens, the lender can demand that the entire outstanding balance of the loan, including any trigger effect increases, be paid back immediately in cash. In some specific cases, certain trigger events automatically lead to an event of default, meaning the loan is due immediately without any notice from the lender. Also, if an event of default occurs, the interest rate on the loan can jump up to 18% per year or the maximum allowed by law, whichever is lower. The lender can then take immediate action to collect the debt. They don't need to provide extra warnings or go through lengthy processes. The company also made promises or covenants in this agreement. Until all obligations under these notes are fully paid, Scienture Holdings must consistently file all required reports with the Securities and Exchange Commission, or the CC they need to ensure enough public information is available about the company and not try to stop being a reporting company. They also promise to keep their stock listed on a national exchange and ensure trading isn't suspended. Crucially, they cannot enter into certain agreements or issue new securities to the lender or its affiliates without the lender's written consent. They are also restricted from granting any security interests or liens on their assets. Except to this lender, the company must provide the lender access to monitor the SCNX sub-deposit account. They also have to report any lawsuits or investigations against them within 3 business days of being notified. The company also promised not to let its subsidiaries issue or guarantee any debt, with some exceptions for normal business operations for Scienture, LLC, and SCNX Holdings. The new subsidiary is specifically barred from issuing debt or conducting business operations on its own. It's important to understand that these promises, called representations and warranties, are mostly for the benefit of the lender. They're ways to allocate risk. They might not reflect the actual state of the company at any given moment, and they might use different standards of what is considered material compared to what investors might think. So investors shouldn't necessarily take these as a perfect picture of the company's current situation. To make sure they get their money back, the lender has secured this deal with several forms of collateral. This includes the deposit account control agreement we talked about, a guarantee from the subsidiaries, SCNX Sub and Scienture LLC, and security agreement. These security agreements give Streeterville Capital a claim on all the assets of Scienture LLC and the parent company. Tree's also a specific agreement on intellectual property. Furthermore, the company has pledged all the ownership interests in its subsidiary, South Carolina NX Sub. Essentially, the lender has a strong claim on many of the company's assets and its subsidiary's ownership if the company defaults. The report also lists several exhibits filed alongside it, which are the actual legal documents for the purchase agreement, the promissory notes, and the various security agreements. Finally, the report is signed by Dr. Narasim Hanmani, the co-chief executive officer, on May 1st, 2026. So, what does all this mean for Scienture Holdings SCNX? They've secured a significant amount of funding, which they say is for growth and working capital. That is positive on the surface. However, the terms of these notes are quite strict. The trigger events, the potential for increased loan amounts, and the strong collateral put in place show that the lender wants to protect their investment very carefully. The high prepayment penalty, especially if refinancing with other parties, might also suggest that the company is looking to this lender for a longer-term solution, rather than a short-term bridge compared to other companies in similar situations. Taking on debt with such strict covenants and collateral can sometimes be a sign of a company that might be finding it harder to secure more traditional, less restrictive forms of financing. This type of deal is common for companies that are considered higher risk. The risk I am watching is how easily these trigger events could be activated, leading to increased debt and potential default. My biggest concern is the string attached to these notes and what happens if the company's performance falters even slightly. What I am actually looking for is a clear plan on how the company will use this capital to generate enough revenue and profit to comfortably service this debt and avoid triggering any of these default conditions. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.